In this video, I'm going to talk about how you can use market maker models with low resistance liquidity runs. So before we start going over the market maker models and low resistance liquidity runs, I would definitely recommend watching the two videos I made about these two ICT concepts. So let's say price comes up and touch a form of higher time frame resistance level. Then this up here would be the Smartman reversal because that is where price starts to reverse. Then price comes up to a low risk sell, and then we move lower, taking out these lows right here. And these lows, there's low resistance liquidity, so that means that price is going to have a easy time going through these low resistance liquidity. And originally, these lows wouldn't be a low resistance liquidity, but when we touch a higher time frame resistance level, it should be easy for price going through these lows with ease. It's very important for price touching a high time frame resistance level because if price doesn't touch a high time frame resistance level, there's going to be high resistance liquidity below these lows. When price touches the high time frame resistance level, sometimes it's just make a large expansion to the downside and don't create a market maker sell model. But when we create this market maker sell model, if you were to take a trade entry, let's say at the low risk sell, and then put your stop loss up at the Smartman reversal, and then target the low resistance liquidity. You could also use standard deviations from the move up to the low risk sell or the move up to the Smartman reversal, and then target the -2 to -2.5 range. And at the -1 to -1.5 range, you want to see a retracement. So now that we know what to look for, we can go into the charts and find some examples of this. So for the first example, price comes down and touch a form of sell-side liquidity, also taking down a lot of lows right here. Then we start moving higher, and this would be the Smartman reversal. Then price makes a propulsion block because price doesn't come down to this change their delivery or order blocks, consequent encouragement, creating a propulsion block. So this would be the low risk buy. And price also respected this fairly gap right here. Then price moved higher, creating a break of structure. And then we get a first stage accumulation. As you see, price creates a 5-minute inversion fairly gap and also comes down and touches this order block, closing above the order block. So this will be the first stage accumulation. Then price moves higher, creating a fairly gap. Then price comes down into this fairly gap. So this would be the second stage accumulation. And then we have our low resistance liquidity up here because we have these equal highs the price comes up to, and then we start to go lower all the way down to the Smartman reversal, not touching it. And after that, price moves even higher. So if you were to take a trade entry, you could buy right here at the top of this order block and in the inversion fairly gap. Then put your stop loss at the low of the order block and target these highs up here because there's low resistance liquidity. And that makes a 4.5 risk reward ratio. So just to give you a bit of view of this, price comes down and take sell-side liquidity, then moves higher, creating a order block or change state of delivery. Then price fails to touch the mean threshold, creating a propulsion block. So if you were to take a trade right at the smart money reversal, you can now move your stop loss up to the mean threshold of this order blocks, and price moves higher, creating a 5-minute inversion fair gap, also creating a order block. Then we have the first stage accumulation because price comes down into the inversion fair gap and order block. Then we move higher, creating the second stage accumulation because price comes down into this fair gap. And then we move all the way up to this low resistance liquidity. So if you were to take a trade entry at all of these areas, I would first at the low risk buy, take a trade right here, and put my stop loss at smart money reversal, and then target all the way up to this high up here. And at the first stage accumulation, you could buy right at the top of the order block within the inversion fair gap. And then if you were to put your stop loss right here and target this low resistance liquidity area, it would only make a 1.69 risk reward ratio. So for that reason, I will put my stop loss at the low of the order block or below the inversion fair gap. And if you were to take a trade entry at the second stage accumulation, could buy right at the top of the fair gap, target these low resistance liquidity, and then put your stop loss maybe at this low or at the body of the fair gap low. And then after we move higher, you could put your stop loss maybe at this low, and when we start to move higher, putting your stop loss at the lows we create all the way up. So this was an example of how you can use low resistance liquidity as your target when seeing a market maker buy model, because we have over here sell side of the curve down to the sell side liquidity where we get the smart money reversal, and then we start to make the buy side of the curve over here. You can also see this is a low resistance liquidity run because every high we take out with ease, and every low we make, there's going to be high resistance liquidity. And as you see, when we move higher, price takes out the highs with ease, not even making a small retracement, just moving higher all the way up to these equal highs up here. You could also use standard deviations on the low risk buy, and as you see, the -2 and -2.5 range are aligning with this bearish value gap, and the -3 range are aligning with the low resistance liquidity. And you can also use standard deviations on the move down to the smart money reversal. As you see, the -1 to -1.5 range, or the -1 to -1.5 to -2 range, are aligning with the low resistance liquidity. I can also just show you on the 5-minute that we created the inversion fair gap. As you see, price closes off this bearish fair gap, creating a inversion fair gap. Then you see this move right here will be the first stage accumulation down to the order block, and then we move higher up to these equal highs up here where there's low resistance liquidity and also safe room for retail traders or easiest buy stops. There's a lot of people that get confused if all the concepts on the market maker buy model also work on the market maker sell model. And I can assure you all the concepts that I've used here can also be used on the market maker sell model. And just a short example of this large expansion, you can see we come all the way down and take out this low resistance liquidity area. So yes, you could also use the concepts that are used right here on the market buy model on the market maker sell model. If you were to take a trade entry on the sell side of the curve, it will be difficult because we get a large expansion to the downside, meaning there's no total retracement in price. If you were to zoom out, you could see price touches high time frame resistance level of this low probability order block, and you could see price consolidates, then manipulates down to the sell side liquidity and low probability order block, and then distributes all the way up to this low resistance liquidity. And then after we touch this low resistance liquidity, we start to move lower, creating the sell side of the curve, almost taking out these lows right here. If you like this video, please like and subscribe, and if there's anything I didn't understand, just comment down below. And also, if you like to engage with other traders, you can join my Discord, link in the description.